Welcome to Section 6 of our Accounting Standards Codification 323 training series. We have built the mechanics of equity method accounting across sections 1 through 5. Now, we answer the questions every preparer and reviewer faces. Where do these numbers go on the financial statements? What does a SC 323 require you to disclose? And how does this treatment compare to international financial reporting standards? Let us work through all three. After this section, you will be equipped to present equity method investments on all 4 financial statements. Write the required disclosures with confidence. Interpret a multi-year worked example, and articulate the key differences between United States generally accepted accounting principles and international financial reporting standards for anyone working across both frameworks. Here is the key thing: a full worked example ties every concept together. You acquire a 30% interest for $600,000. The investee's book value implies your proportionate share is $450,000, leaving a $150,000 excess purchase price. You allocate that to a property and equipment step-up amortized over 10 years at $6,000 per year, an intangible amortized over 5 years at $6,000 per year, and $60,000 of embedded goodwill that is not amortized. Year 1. Investee earns $200,000, so your gross pickup is $60,000. Subtract $12,000 of amortization, leaving net equity and earnings of $48,000. Investee pays a $50,000 dividend, of which your 30% share is $15,000, reducing your balance. Year-end investment, $633,000. The surprising part is how the suspended loss recovery works. When your investment balance hits 0 in year 3, you stop. Even though the investee is still losing money, you carry forward $30,000 of unrecognized losses. In year 4, the investee recovers somewhat, and your share of income is $12,000. But that does not clear the $30,000 suspended amount, so you still recognize nothing. In year 5, the investee earns more. Your cumulative share of recovery now reaches $36,000, which finally exceeds the $30,000 suspended. You resume recognition and record $6,000 of income. The key principle is that you must fully offset suspended losses before resuming any income recognition. Now let us place these numbers on the financial statements. On the balance sheet, your equity method investment appears as a single line item in noncurrent assets. You are not consolidating the investee's individual assets and liabilities onto your balance sheet. One number, one line. On the income statement, equity in earnings or losses appears as a single line item, almost always presented outside of operating income alongside other non-operating items. Many companies label it simply equity in earnings of equity method investees. This clean presentation is one of the defining features of the equity method. Let us move to other comprehensive income and the cash flow statement. In the other comprehensive income section, you report your proportionate share of the investee's other comprehensive income items in the same categories the investee uses: pension corridor adjustments, cash flow hedge gains and losses, and currency translation adjustments. On the cash flow statement, the initial acquisition is an investing outflow. Dividends received are typically an investing inflow, though companies may classify them as operating under a policy election. Here is the tricky one for the indirect method. Equity in earnings is a non-cash item on the income statement. Under the indirect method, you start with net income and adjust for non-cash items. So you deduct your equity in earnings and add back equity in losses. The cash effect appears separately in the investing section as the dividend received. Accounting Standards Codification 323 requires substantial qualitative and quantitative disclosures for each significant equity method investment. You must identify each investee by name, disclose the ownership percentage, and explain why you have significant influence if it is not based purely on ownership percentage. You also provide aggregate carrying amounts and aggregate equity in earnings or losses for the period. For significant investees, you include summarized financial information, balance sheet, and income statement data. Or, if the investee is a public company that files with the Securities and Exchange Commission, you may reference those public filings instead. Watch out for this one. The disclosures go beyond just the carrying amount. ASC 323 also requires you to disclose how any excess purchase price was allocated, which assets received step-ups, what useful lives were assigned, and how the amortization flows through equity and earnings. If you recorded an impairment, disclose the nature and circumstances. If you have suspended losses sitting off the books, disclose the total amount and why recognition was halted. And if you have guaranteed any of the investee's obligations or committed to fund future losses, that commitment must be disclosed as well. These disclosures give readers a complete picture of your exposure. Let us now compare this framework with international financial reporting standards. The two frameworks are more aligned than many expect, but two differences are substantial. First, the consistent areas. The 20% threshold for significant influence is the same in IAS 28 as in ASC 323. Both require the equity method for associates and joint ventures. Basis difference allocation works the same way. Loss suspension at zero net investment is also consistent. Now the key differences. International Financial Reporting Standard 11 creates a category called joint operations, which does not exist under United States generally accepted accounting principles. And the impairment models diverge significantly. United States generally accepted accounting principles uses a single-step write-down that is not reversible, while International Accounting Standard 36 allows impairment reversals when conditions improve. Here is a practical scenario you may encounter in cross-border work. A company reporting under International Financial Reporting Standards has a joint operation under IFRS 11. On their IFRS balance sheet, they have recorded their proportionate share of the joint operations assets and liabilities directly on their own balance sheet, line by line. When you convert that to United States generally accepted accounting principles, all of that goes away. You remove those individual asset and liability lines and replace the entire structure with a single equity method investment line item. The balance sheet gets smaller. The income statement is restructured to show equity and earnings instead of line-by-line revenues and expenses. This is one of the more significant reconciling adjustments when working with IFRS reporters. Let us close with the essentials. Your equity method investment appears as a single line on the balance sheet and a single line on the income statement outside operating activities. In the cash flow statement, adjust out the non-cash equity pickup and show dividends as an investing inflow. ASC 323 disclosures are comprehensive, cover all the required elements including suspended losses and basis difference amortization. And when comparing to international financial reporting standards, the joint operations category and the reversible impairment model are the two areas most likely to produce significant differences in cross-border reporting. Thank you for completing this section on presentation, disclosures, and the IFRS comparison. Section 7 moves into controls, audit considerations, and period-end closing procedures. Thank you for watching. Subscribe for more training from P&J Group.